Hi, everybody. I trust you are well. And I hope you've had a fantastic week. And you're having a fantastic week so far. So here we are in the market, another day, price action trading. My name is George. I hope you guys are all well. I want to have a quick look. Well, not a quick look. So here are the three markets that we're looking at. Euro versus the dollar, both on the daily. That's where we get our macro view, and then we trade off the 5-minute time frame. So I think I've said it a lot of times, and I always say it. What you set up on the on your chart, on your intraday chart, your 5-day chart, is going to determine how successful your day will be. So these extreme levels, previous low of the day, previous day's low, previous day's high, are extremely important. Whatever time you come in, whether you trade in the Asian session or the London session or the US session, you always have to put that in. So I've just kept my charts scrunched up for now. We'll zoom in and have a look at what's happening in our day so far. But the high-level setup is important for us to just keep talking about it until it becomes second nature. So there I have low and high. Now, something else which I've got on my charts, and we've been speaking about it. Remember, whenever the market breaks out of a trading range, the market always wants to go and test or break through the measured move of that trading range. So firstly, whoever is creating the trading range, they want to get to that measured move because that's a magnet. And if you are counter trade, and on the other side, you want to see if there will be a failure at that measured move or a successful breakout. So it's important for us to just put on our charts measured move of yesterday's trading range. So yesterday's range is the day's trading range. So if the market breaks through that, it will likely want to get to a measured move. And we can see just on Euro, we're not too far away from reaching the measured move of yesterday's trading range. What's important then when we get down to look at our time frame, our 5-minute time frame, is just for us to see if the market has, there was an opportunity for us to jump in the market. So we're going to talk about that. The reverse is also true, guys. So if from the open, the market had broken out above that, then of course we'd have had to put a measured move of that trading range. Let's just show it. I'm going to take it off because the market is not going in that direction at this present moment, so there's no need to keep our lines in, but there is a measured move. Okay, so if the market broke above that, the first distinct magnet that the market wants to rush to or wants to get to and try and break out is that measured move. So, well, let me leave it in for now, but I'll take it off and I'll leave the line on just to keep the charts not cluttered. So when we've spoken about breakouts, you probably heard me say it often, especially when I talk in terms of news, because I stay out of the market when news is coming up. We got ADP coming up in about 2 hours and 40 minutes or so from now on. So if I'm in any trades, if it's one single notification of red news, I want to be out an hour before. If it's 2, then I'll be out 2 hours before. If it's 3, like Friday is going to have 3 news notifications. 3 hours before that news, I'll be out most likely then, unless I see something setting up or I've been holding a trade out of the Asian session or something sets up in the early part of the London session. I don't want to be in the market before. Reason is there's a lot of forces that are in the market when that news comes out, and it makes it reduces the probability of success in terms of trading the price action. Some guys can do it. I'd rather not. I'd rather stay out of the market, and it doesn't take long for us to get back in. As soon as the news candle is settled, all we want is a couple of other candles, and we can start to see clearly what's happening and decide whether to jump in or out. The reason I'm pointing that out is that whenever there's a strong breakout after a news announcement, what I look for is what is the extent of that breakout. So if we have a strong breakout, in other words, right from the news, it could be a small tail that is formed, but in the direction of the breakout, if it closes on or near its low, if it's a bear breakout, or if it closes on or near its high, if it's a bull breakout, then I want to see whether there's follow through. And if there's follow through, then I know I have a confirmed breakout. Or it might be one of these just huge single trend bars that I created. But nevertheless, if you have a breakout closing on or near its low, the first thing you want to plonk in is from the start of the breakout. I'm just going to show you this illustration, then I'll tell you why I mentioned that here. So let's assume our breakout started here and the breakout ended there. Okay, so that's the extent of the breakout. The thing you have to put plug in terms of price action is the 50% level, because the 50% pullback is a very strong magnet. If you can go back, look at charts, over and over again and see where there's a strong breakout and where there's a pullback, you will see that more than 75% of the time, the market gets to the 50%, bounces off that and continues back into the trend. So that 50% pullback is important for us. Now, the reason I'm mentioning that is that the range of yesterday, 50% pullback. Let's move this to this side. Okay, 50% pullback is right here. Okay, that's half the trading range of yesterday. You can see the market opened almost in the middle of the range, bounced off that 50%, and then it carried on down. So you need to mark those. Then the other thing you mark, of course, is the open of the day. Open of the day, then the 50% highs and lows. Let's just have a look at the euro itself on the daily. Okay, so when I'm trading on the 5-minute time frame, which will be the same if you trade in intraday, lower than the daily time frame, it's important to have a look at what's happening on the day, just to get a sense. And to get a sense is a critical thing. You don't want to get a bias. You don't want to get a bias that you hold on to so strongly that if you get a reversal on your lower time frames, you are so stuck in the bias that you miss the trades. So get a sense, and if you like to use the word bias, hold on to it very gently, like holding an egg, and be prepared to change your bias if new information comes to you on the lower time frame. So I'm really excited by what's been unfolding here, in the sense that when we started talking about these levels of resistance up here and talking about measured moves, all of this had not formed. So if you go back in the archives, you'll see, if you get back to the end of July, etc., all of this had not formed. But what we spoke about in terms of what might happen with price action has been unfolding before us. Now, the thing we want to get to with price action trading, we want to read and study so many charts that these patterns become ingrained in our very brains, so that we can be certain when we trade our strategies that when this particular setup comes, I am 100% certain that if it's a trend, 60% of the time it will work. I like to say that. So our strategies, even though sometimes if the setup is very strong, you have a higher probability. I always want to work off 60% probability if I'm trading my trend pullbacks. Okay, pullback to the EMA after a breakout. First pullback must be a pullback to the EMA for me to trade it. Or then, if you don't get that, you get a pullback to the 20 EMA, and then you look to trade that. There's various ways that we speak about to find the actual, to confirm the pattern. But if I do get that and everything else ticks the boxes, then I know 100% of the times, I'm 100% certain that 60% of the times this strategy will work, which means out of 10 trades that I take, 6 should go my direction. But 4 out of 10 I'm going to lose. So we have to train ourselves, coach ourselves, accept that this is a business that has cost of sales. I like to think in terms of cost of sales. You know, I'm an accountant by training. It makes it easier for you to accept that you will lose in this game. Okay, our cost of sales is when the trade goes against us. But if we get very good in our business, we don't just go and spend money unnecessarily on goods that we don't want. So don't trade patterns that are not part of your strategies. You can find ways to trade. You can always be in the market if you want to, if that's the way that you trade. But the goal is to make money. The goal is not to have fun trading. You can enjoy your business, but we don't come here to have fun. If you want to have fun, man, there's other hobbies that you can get involved in. Our goal is to make money, and our goal is to get in the market, find our strategies, and execute them. So this has been quite a beauty in terms of what you're talking about. What's important for us to bear in mind, and you can apply this to any time frame that you are trading. Okay, I'm not going to repeat everything we've covered on the left, but at the present moment, there is a trading range that formed here, that low and that low. And remember, we said if the market breaks out beneath that and there's follow through, the magnet is going to be a measured move here. Okay, that's why we've marked that level, 1.14, that kind of range. And of course, beneath that low, that double bottom, to a double bottom at this stage. Okay, higher low, double bottom there, but it was a double bottom. So the double bottoms are not always perfect, but there it was. We had a breakout beneath. The breakout is this candle, not this small candle that had a doji behind it. That's not the breakout. The breakout is this one, and there was follow through. This slightly thicker blue line is an earlier double bottom. Okay, earlier double bottom here. Okay, in September and October. So the market also broke beneath that double bottom. So that's significant. So in terms of breaking out beneath this low, strong breakout that closed on or just below the low of that double bottom, which was also a leg one, pullback leg two. So that was a significant level of support, okay, that everyone was looking at. Bears say, well, will the bears close beneath that? They had a follow-through tails on it, but it was a follow-through candle, not a strong follow-through, but that breakout followed through nicely. So then at that particular stage, in the way that we trade, we would have been saying, pullback, first pullback to the 10 EMA, let's look to getting beneath that. So not sure if you had been triggered here, but if you had, your stop would have been up here on the daily time frame. And your goal is to get down here. So you'd have to try and hold it to get down there. That's on the daily time frame. So we're gonna just open up the euro a bit. Then I'll also look at gold and S&P 500. So this is today's trading. Now I've just found today quite fascinating, and I'll explain to you why. Let's just have a look at it from the Asian session. So depending when you came into the market, let's have a look at what's happening. Let's have a look at what's happening. So you see where I marked my open of the day there. Okay, but if you look at that huge spike on the changeover, if you want to call it that. So I just ignored that, that's an anomaly. But, you can put your open there if you wanted. But what's important, if you're in the market, this is absolutely important. You've got to have clarity in terms of what is happening. We don't just jump in because we see something. So repeatedly, I've been saying, just allow the market to flow and start to get information. So right about here, all you can clearly see is we're going sideways. So it's a trading range price action. There's nothing for us to trade, because if a trading range is forming, if we trade in trading ranges, which we do when we are looking at our major trend reversal strategy. So there's two primary strategies that I teach and coach you guys on. Okay, trend trading. So when the market is broken out and there's a pullback, when I trade pullback to the 10 EMA, that's the first sign of strong breakout. Then when I look at pullbacks to the 20 EMA, etc., etc. But when there's a transition, that's a major trend reversal alert. That alerts us to the fact that out of the trading range that's created when the market is transitioning, there might be a reversal out of that trading range. And if there's a reversal out of the trading range, we can then jump in based on our strategy, which means we can get in on the earlier part of a potential breakout into a new trend. Okay, then when you get in, then wait for the pullback. Alternatively, out of the major trend reversal alert, market may not reverse, there may be trend continuation. Again, if you look at how the trading range is forming, we can jump into it and trade. And then the early part of that breakout of trend continuation, then the pullback. So two primary themes in our trading: pullbacks to the 10 and 20 EMA, and we want to trade major trend reversals and see if we can catch a reversal or a continuation before it forms and get in early. So here, I mean, so you can see, okay, 6 candles, 6 or 7 candles, trading range, nothing for us to trade there, but we got to wait and say, well, let's see what is likely to happen. Okay, we've got a 50% pullback from yesterday, key level that the market watches. There is a range of yesterday. Can we get to 50% of that? And surely the market gets there indeed, but it does not break out. So it kind of bounces off that. So now we have a low, we have a high, and waiting to see if the bulls are strong, you know, they will come back and give us a proper breakout, which we can look at trading. But we don't get that, we get a double bottom. So beautiful. Now we have a double bottom, we have a high. So we can now start to say, okay, measured move. If market breaks beneath that, market is likely to get down to there. If, on the other hand, the bulls are strong and the bulls break out, we're going to get to there. But we're not trading anything because we first got to have the pattern formed in front of us. So at this stage now we have a double bottom. Fantastic. Double bottom means that's a potential bottom of a developing trading range. If you get a double bottom, for you to say I've got a trading range, I want to take, you want to see a double top or you know, it could be the same level, higher high or lower high. Then you have, okay, I'm trading a trading range. Okay, double top, double bottom, I'm trading a trading range. If you only have a double bottom and the market starts to break out, it's a different kind of pattern that you're still a trading range, but it's a different pattern. It's not the trading range will be looking to trade out of major trend reversal alerts. But what we do, because we have a distinct range, lows, highs, potential major move, and let's see what happens. Why is that interesting to us? Because if the market breaks beneath this double bottom, give us a breakout candle and a follow through and a pullback, we can happily look to trade that. We'll find where to put our stop, but there's a target that we want to go to. So why I say this is fascinating, because, you know, I came into the London session, which we'll get on to just now, and I've been looking and say, well, you know, where would I have jumped into the trade today on the Asian session? So far, there is nowhere for me to have jumped into the trade here. I'm analyzing it, I'm looking at it, I'm waiting to see what happens. Okay, we've got a pullback. So we've got a bounce off the double bottom. There's no acceleration. You can see from the double bottom, the bears are strong. We should have had acceleration. You get a doji, you get an inside candle, you get another doji. Everything is important in terms of you know, the way that we look at price action, bar by bar. So it's all information being given to us. So immediately, I would have been saying, but hang on a second. There's something wrong here. If the bears are strong, there should have been acceleration. The bulls are strong, there should be acceleration. So let's wait. Let's wait and let's not jump into the market. Only jump in when we get given more information. Okay. So out of that, all of these dojis are trading ranges. Okay. So whenever you see a trading range, if you get a breakout, you expect there to be, most breakouts fail, put it that way. Most breakouts fail, in which case you wait for a pullback. So there's a breakout. Not surprised that we get another doji there. Then we have an outside bear candle. We have bears trying to resume. Nothing for us to jump in because we don't have a strong breakout here. If we had a strong breakout here beneath this level, we would have said, oh, okay, fantastic. Now let's look to trade. But there is nothing. Then we get an outside candle forming. And you got to start again because an outside candle is a trading range. If you're in a trading range, what do you do in a trading range? You look to sell high back into the trading range, or you look to buy at the bottom going up. So nothing for us to initiate there. What you can do, because it's a trading range, okay, and say, okay, if I do get a breakout beneath that, that's the potential measured move. If the bulls, low and high, if the bulls, the bulls break above that, that is the potential measured move. So it's quite interesting that, when you start to read price action, you can see nothing is accidental. Someone is putting it there, computers, traders, whatever the case may be, because the bulls are saying, hang on, if we can create a breakout above there, at least let's go and attack the 50% pullback because that's significant. And if they get past a 50% pullback, of course, then, look for opportunities. Then what do we get? We get the bears closing beneath that low. Now, I'm careful not to say bear breakout because that's not a bear breakout. There is a candle that attempted to break out beneath that low and it failed. Okay, close just within that low. That's not a strong breakout. But let's look at the next candle. We have another candle that follows through. Then we have buying that's taken place at the bottom. So again, not a strong breakout. So if it's not a strong breakout, you can't be saying, okay, let me find ways just to jump into this trade. Chances are it may keep on going down, but not giving you the setup. But if it's not your setup, don't jump in because you don't want to worsen that trader's equation. If we say in our strategies that 60% chances we'll make money, and when we do make money out of those 60% chances, of course, we can get quantum returns, 1%, 1%, 2%, 3% of the 1% you risk. In other words, 100%, 200% or 300% return if you've waited for it. So nothing is forming because there is no breakout pullback. There's nothing much you can look at here because there's no breakout. Okay, so you just have to wait and say, okay, what do I do next? Keep waiting. But your waiting is not just watching the charts. As a price action trader, you will make a lot of money, but you're not going to get paid by the market by sitting and looking at the market without actively doing anything. Okay, you have to be in the market, drawing lines, deleting them, marking them. That's the work that we do. Okay, so we have our trading range, high, low. So, but as it's forming, I had that particularly in a lower high for you to put in at some stage. Before all of this form, you say, okay, I have a lower high, but it's a bull candle. There's no ways we're going to sell a bull candle, even if we had a strong breakout here. Wait for the bear breakout, okay? Attempt to break beneath that fails. Now, that's when you kind of say, okay, that's a key level. Let's see if we get to that for the bulls. There's been no breakout above that. That's a key level, which is almost at the open of the day. So we wait. But remember, we've got three markets that we look at, okay? So you won't be staring just at the euro. You could have looked at gold or looked at the S&P 500, which we'll jump into. But let's see what else is unfolding on the day. So we had all of these measured moves. That was the largest trading range on the left. And we kind of leave it there. There, the market didn't quite there, but leave that there because all of these are invisible levels of support. You don't want to clutter your charts, so just have to be careful. But at least you can see. I used to do this. I think it's fair just to show you. Okay, those are all invisible levels of support. But because I like to keep my charts clean, and I've trained myself to keep looking to the left. Before you cross the road, keep looking to the left. So I just kind of leave them there. I know that, okay, there's a level within there somewhere, so I'm not surprised when the market does itself. But we get to here, to that low. Again, we're waiting to see, say, oh man, look at the bears. We have a lower high. Isn't that beautiful? Okay, it's a bull candle, but it's a lower high. And the bears are about to resume. Let's hope we get a strong bear breakout. We don't get it, but we have an immediate pullback. And off the 10 EMA, off the 10 EMA, we get a bounce, but it's a bull candle. It's very important for us. If the bears are strong, why are they not able to bounce off the 10 EMA and close below the midpoint? Give us a bear candle that will say, okay, we'll take this stop in the right place. So nothing for us to do. So that's another low that's created. Okay. Again, big bear candle, but bouncing off that low. Follow through tail, doji. So you can quickly see that although the market is trending downwards, there is no strength. There is no strength in the bears for us to jump in and say, okay, there's an opportunity for us to jump in. Every time the bears try a move, the bulls come back. Okay, bears, bulls, bears, bull outside, trading range created again, like we had up here. And again, we could do the very same thing and just try not to clutter our charts. Okay, and if we break beneath that, nothing happens. So ultimately, keep it clean for now. Trading range, inside candle, bears try, but they're failing. So what we get now is, oh, that is very interesting. Now we have a wedge. Remember, every time we have 3 attempts to break beneath a particular level, it's a wedge. The market is trying to break beneath this, but why is this price so important? Well, remember what we had out here. Unfortunately, we couldn't find ways to get into the market. Okay, so it's fine. We don't worry about it. If we start to jump in because it looked like this and we see it again, well, you know what's going to happen to your 60-40? It's going to go to 50-50, that then you start losing. So just let it be, because they will come. So we have a lower high, we have a wedge, and now we're starting to think, okay, so is there some form of a trend reversal that's going to form here? It's not a very strong bear trend. Okay, it's market is trending down, but it's not a strong bear trend. But we haven't had a strong bear breakout as well. So let's see what happens after the wedge. Well, we have a beautiful enough breakout from the double bottom after the wedge, which is good, and follow through. So fantastic for the bulls, right? At this stage, we have a decent breakout from a wedge bottom. Let's see if we get a decent enough pullback and bounce off the EMA. We don't get that. Okay, we still get this bear bull thing that is forming. And at this stage, we're saying, okay, this is confusion. And confusion is good, because if there's confusion, it means there's a trading range. Okay, the market is trying to decide where to go. So now our mindset is going to be, okay, back in trading range. If it's a trading range, I am looking to sell at the top of the trading range and try and take profits at the bottom if I get the setup. Okay. So from this here, we have another attempt by the bulls, which fails with all these dodgy patterns. Then we have that. So we had a lower high double bottom, an attempt that has failed. Now we have another lower high double bottom, and the trading range is being formed here. Here the bears try to break out, but they fail. We have a double bottom in a bigger trading range. The bulls have a chance to resume. If the bulls are able to give us this close above the moving average and a follow through, which closes above this, and say, okay, the trading range seems to be broken out. The bear case has now been reversed completely, because remember, from a trend, we enter into a trading range. And in the trading range, that's where we look for major trend reversals. We're in a major trend reversal alert, where we are looking for the market either to reverse into a new trend or for trend continuation. That's kind of where you are. So by now, man, you've been sitting for probably 5 hours, right? Or you could have been fortunate to come back to work from work and see all of this stuff. Say, oh, okay, let me wait and see what happens. So in any case, nothing for us to have traded there, but we know what's happening. We're not going to be taken by surprise. Okay. So here's what then happens. Lower high fails. And now we have a double top coming from that wedge fail. Bulls fail to create a reversal or a breakout above that. And then we have the bears resuming, and we have a decent enough reversal after this double top. Okay, so even though you've got a few candles there, remember I've said I prefer to see separation. So all of that is part of the double top for me, whether you put it there or put it there. You need to see a separation. I like to see at least 6 candles. So we have it's been trending downwards. Bulls have failed. We have a lower high double top after the break above the moving average. We have another lower high being formed and say, okay, now fantastic. Let's see if there's opportunities for us to trade the trading range. Okay, in a measured trend reversal, that we are in a trading range. If it then breaks out, it gives us something else fantastic. So we're trying to see if we can take trades all the way down to here. And remember, whenever you initiate a trade, you always have 2 options. So decent place to take a trade. Okay, you don't want to take it lower because you trade in the trading range. You haven't seen all of this. You might get down to there and just start to give you tails, in which case you get out of your trade, right? So you can take a trade there. Let's just put it quickly. So you could take your trade there. Okay, let's just assume you put your order, we place an order, okay? Place an order in the market and your stop is above here. You would double top, lower high, your stop is above here and you're aiming to get there. So best way is set your take profits and take the profits, bottom of a trading range, okay? But if you're there to watch your trades, to manage your trades, which I do 90% of the times, okay, I take it and I wait and see. If I get here and I start to get wedges and stuff like that and tails, I just close the trade. But sometimes you get rewarded with this. But I was not in the market at this particular time. So 2 options, take profits or wait and say, hey, yeah, fantastic. George has been talking about this. There is a breakout, bear breakout, follow through, but we're in a trading range, but we have a breakout beneath the trading range, close near it, slow, follow through another strong breakout. Fantastic. The bears are out. They're back. Finally. Back with strength. So that's a decent enough breakout. You know, that measured move has already been satisfied. So that's a decent enough breakout. Let's just do this. So you could have traded this. Okay. Now, let me correct myself. You would have traded this as a trading range. Okay, when you see the breakout, now you're looking to say, I want to look at the first pullback to trade. Okay, the first pullback we want to jump in is a pullback that bounces off the 10 EMA. That's the one that we want to trade. So what we get here, we have the breakout, we have a pullback, and we have a resumption. That pullback is good enough for us to measure where we think the market may likely go. Okay. Leg 1, pullback. So the market may go there, but that's not the pullback that we want to trade. We want to see a strong breakout. We want to see the bulls try and reverse the trade. They want to see this bouncing off the 10 EMA. That's the trade that we want to take. So this didn't get to the 10 EMA, so we don't take that. So if you haven't taken that trade, or if you've taken the profit, you still see this, you still see the measured move, but you got to wait to see opportunities to trade. Whenever you see a breakout, 50% pullback, okay, significant level, then you got to look at ways to jump into the trade. So there's a 50% pullback, the market gets into that. So first pullback, there is a bit of a pause, but there's a second pullback, bounce off the 50 EMA, good. If the bulls are strong, they're going to close above it and give follow through. They didn't. They tried to close above it, failed. Bears came back into the market. Then we had this close at the 10 EMA. Now, you've got the measured move, you've got the 50% pullback, you've got the first attempt to break beneath it, to break above it, that failed. You have a second attempt that has failed. Now, because of the strength of this, you can look to get into the market anywhere in here. You can put your entry beneath there. Okay, you can put your entry beneath that candle. To put your entry beneath that, your stop is there. You get triggered in, you see that outside doji, Best thing is to wait. We're still waiting to get the wait for the next candle. That's good enough to get in. But if you're getting that your stop is not here, your stop is up here. Okay, the only time we pull our stop down is after we've had the breakdown, break below this low and a pullback. So if you take any trade in here, but we're already there. So let's assume you're going to take a trade in here. At that point, you can put your stop up here. So right now, any trade that you take, any of those trades, okay, stop is up there, but you're waiting to come here. Still don't ignore that. You're waiting for the measured move. So you observe it. You know, if it starts to go sideways, you can close your trades. Okay. You might be able to get a break even, a little bit of loss on that or a loss on that. But as it is, we go to our measured move, take your profits out, and now you got to wait for the next setup. Okay, wow, this is taking some interesting time. So let's keep looking at it. I'll look at gold and S&P 500 shortly. Okay, so you've taken your profits out of that. Now, here's what's interesting. This break below here is very significant. Why? Because remember, we marked the low of yesterday. So the low of yesterday is a significant level intraday of support. So you want to see, okay, are the bulls going to come into the market at this level and reverse this, or are the bears strong enough to break beneath that level? That's why we mark it. That's a significant level. What you'd have wanted to see, let's say you were holding on to your trade and you were not going to close it down here. You want to say, okay, let me see if there's follow through. There's the follow through. If you had your take profit, you have banked your money. But you could also have held out to say, if the bears are strong, you want to give me a break beneath yesterday's low. Okay, after this break beneath that low, and follow through. If they give me that breakout beneath yesterday's low and follow through, then I can look to either initiate a new position if I'm not in a trade, or I can start to build a position. But look at this. Profit taken in that measured move, bears failed to break beneath that. Yes, there was resumption, but on what basis do you want to take this trade? There is no basis, because this breakout is not strong at all. Okay, although there's a decent setup. I mean, if you want to scalp and take that trade and get to that, if you're a scalper, go ahead. But we don't scalp. We want to hold our trades and make these 100%, 200% returns on the money that you've put into the capital, into the market, the money we've invested. Interesting enough, I was talking to some guys, and I said, you know, when you take a trade, if you wait and you swing your trade, you can get a 200 or 300% return on the money that you've invested in the trade. They looked at me strange. They said, how is that possible? I got so much money in my account. How can I get that much? And I said, no, it doesn't matter how much you've got in your account. You don't put that money into a trade. We're not here to gamble. We're here to trade the market intelligently. So you take 1% out of the money you've got, you take 2%, you take 0.5%. That money that you've put in the trade, that's what you can make 200-300% on if you are trading the way that we're talking about. Scalpers can still do that, but they're in and out and in and out. That's a whole different ballgame, which I'm not talking about here. In any case, so nothing for us to get through there. And here's what's interesting now. I mean, I've been watching this from when I came into the market. And I saw all of that, and I'm saying, okay, I want to jump into the market and see what opportunities I've got to take the trades. So when you see all of that, and remember what we'd seen on the daily time frame, okay, we've seen on the daily time frame, that's the opportunity to get there, and we want to break, the bears are breaking beneath that. The goal is to get here. Will they get there? Who knows? But that's the goal, because that's the measured move. 60% chance is that they'll get there, 40% chance it may reverse. So that's good news. And there's the low of yesterday. Okay, so now I'm observing that to say, anywhere for me to get into this trade, there is no way for me to get into the market at this particular point. This was a measured move. And if the market broke beneath this particular level, then you want to look at a measured move. But look at the breakout. One candle breakout, where are the follow-through candles? No follow-through candle. Then we get another bear breakout beneath that low. Again, a reversal back to the 10 EMA. Nothing to jump in as yet because you don't have the breakout that you're looking for. Okay, you don't have the confirmed breakout candle follow through, pull back to the 10 EMA. Let me jump through like one of those trades we looked at last week. So you kind of watch this and say, man, this is not giving an opportunity. Look at other charts. You come back again, and now something else has formed. And you can say, okay, no, that's fantastic. So what we have here, if the market breaks, so here, look at this low. So I just skipped. Again, that low, one candle breakout, one bar breakout, follow through. You're kind of hoping that is a follow through and it fails. So that you can't take that trade. Okay, it is trending down, but your strategy is not forming up. What do? You just stand back and you wait and say, okay, I'm going to wait and see what happens. Then we have that pattern, that pullback that we didn't trade. And you kind of say to yourself, okay, there is a measured move. If I get a breakout, pullback to the 10 EMA, I can trade it. The market is getting to the measured moves. It's doing what it does, but we're not getting the breakout that we want. So beneath this low here, that's the low that we're looking at now. You're saying, okay, I just want to see a breakout, follow through, pull back to the 10 EMA for me to trade. First, pull back to the 10 EMA. Well, we do get a breakout close beneath that, bit of a tail, but that's fine. Follow through candle, beautiful. Now I'm waiting for a pullback to the 10 EMA. First pullback, I don't get a first pullback. I get this pullback and attempt to resume. I get another pullback, then at the 10 EMA. I don't take second pullbacks on the 10 EMA unless I've taken a first one and bank some money, because that first pullback to the 10 EMA, and if I get a reversal, it's an indicator of bearish strength. So I just move on, wait and see what happens. So nice bounce off the EMA, 10 EMA, but it's not the first pullback. So nothing for me to trade. But lo and behold, the market keeps on trending downwards. Okay. Nice reversal, close near the low, break beneath it. And I'm saying, okay, finally, bears were strong. Let's see if I get a follow through. There's a magnet right there. Okay, remember we spoke about that magnet, that extension. So there's a little bit left, but I want to see if I can get in. Then I get sideways price action and another attempt to backward, sideways price action, another attempt. Then I have a break beneath that, but it's moved so far that I haven't had the setup. So I'm just sitting back and saying, okay, I'm going to wait this out. And what I want to see now, I want to see a break of this whole trend line that's been forming all the way since morning. I want to see if I'll get a break above that. Okay, then I'm into my major trend reversal alert. I want to see if there's a resumption, major trend reversal alert, the rules are break above a trend line. Okay, close above it, a resumption of the trend, see if you get a double bottom, then look to see if there's an opportunity to go up. If there's no opportunity, will there be a trend continuation? Might come in after the news or so. But right now, nothing for me to look at. It's quite interesting. Question is it frustrating? Far from being frustrating. That's price action. Many times I share with you some of these beautiful winning trades, and it's like, wow, exciting, and it is. But the other side of it is the trades that you don't take. Okay, I might have to emphasize that, the trades that you don't take. So when I say our trend strategies, 100% of the time, 60% the work, 60-40 ratio. Okay, major trend reversals, if they work, you have to manage your trades because you're taking trades in a trading range. But when you take a trade out of the trading range into a reversal or a trend continuation, if you manage it well, you're going to be able to get 3 to 1 etc., 2 to 1, 3 to 1 on that first trade. But now think about it. You can now wait for your pullbacks to come, because if there's a breakout into a new trend or continuation, what's next to follow? What's next to follow is trend pullbacks, 10 EMA, 20 EMA, then you can just build your positions. So point is, let's wait. Now let's have a quick look at gold. Okay, so gold, this is what gold is looking like on the daily time frame. Okay, we kind of spoke about it a few weeks ago. There is a descending trend line. Tried to break above it, failed. Yesterday was almost an inside candle, almost inside that, very slightly, but an inside pattern is a breakout mode. But the question you got to be saying to yourself, okay, this is a trading range that's been created. So any break beneath the trading range, 90% chance is that breakouts will fail. If it's successful, when I go for a measured move to get to here, no surprise, because of that low and where the low closes were here. If the bulls break out above this, they want to get to that level. So on a daily time, on a 5-minute time frame. All right. So remember, we kind of spoke about it at length on the euro. So because of time, I'm not going to go through it in much detail, but let me point out for you again. You always need to mark low of yesterday, key level of support has to be there. High of yesterday, key level of resistance. 50% pullback, there is a high. There is low of yesterday, there's 50% pullback there, which is almost where the market closed and opened up yesterday. Then if we get a bear breakout, we expect that our measured move be down here. So that's to be a nice profit-taking level or target to get to. Bull breakout the other way. So here's what's been happening with gold. Very interesting markets that's forming so far. So right now we are creating a trading range at the low of yesterday. Okay, so if it's a trading range, we've got to wait to see. We need a double top, we need a double bottom, then we need to see a higher low or lower low. And if we get a double top, so let's assume this forms a double top here. We're gonna have to wait for a lower low and see if you can get a resumption by the bears, or you get a double bottom and a higher low. So trading range is breakout mode, but you just have to wait for it to form. Again, you know, I think it to be, if you have the time and if you have the time, every price action trader should have the inclination to keep looking at charts. I'm always analyzing charts, past charts, just continually to just drill this thing, you know, in me. So very quickly, I want to look at S&P 500. Just show you S&P 500. Just show you some of the patterns that you might find, you know, when you're doing your own analysis. Measured move, where is it likely to go? Likely to go there. Expanding triangle, which is fantastic. The expanding triangle. If you get a break beneath the high and the low of it, you might get a measured move as well of that. This was a higher high double top, but still lower than that. So still bearish in terms of your bias towards the bears. Double bottom, we have a double top. Want to look for a lower high. That would have been a decent trade for you to take. If you take that trade, your stop has to be there. Okay, double top, lower high, your stop has to be there. So that would have been a decent trade, and you're looking to get to the bottom of the trading range. If you're taking your profits, take the profits out. If you're going to manage a trade, which is simply, let me see what happens, because I'll be quick enough to make a decision. If it reverses, I'm not going to hesitate or worry about it. Just get out of the trade. So you could have held on to that. And again, you know, we have a breakout, dodgy, small follow through, not strong. Pull back to the EMA out of that, out of an outside bar. You don't want to trade that. Wait for it. There's a double top. We wait for an opportunity to jump into the trade. You would have tried there, not been triggered in. There's an outside, an inside candle, and you get an inside candle breakout mode. If you want to take that, you take that. Your stop is still up there, okay, because we haven't broken beneath this pattern. If you didn't take that and you wait, you see that, beautiful, but it's a bull candle. We don't take that. Wait for that. That's a trade you could have taken. because you haven't broken beneath this pattern, your stop is going to be up there. Or remember what I said the other time, if you see a breakout, you can put your stop at 50% pullback. You might get stopped at more often, but that's a legitimate place to put a stop at. So you could have taken that trade. So far you could have taken 1-2 trades on gold quite comfortably. Okay, then we do have price reaching that measured move. Let me just check. Oh, excellent. Welcome aboard, Veronica. If you thank you for coming to the first session. If you go back into the archives of this show, Live Trading Profits, on the website, so YouTube's Actions to Wealth, YouTube, you'll see all the videos. We've been running now for almost 10 months, so it's quite a wealth of information there. And I look forward to joining you again, and just keep popping in the questions. Okay, so breakout, and if you get that kind of breakout, profit taken there, but if you still want to hold on to it, the question is what happens after that. Now, we then get this wedge pullback, okay? And after there's 3 pushes back, 1, 2, 3, 50% pullback in there. Just plonk it in quickly. Okay, so get 50% pullback, failed to break out about it, but what does it mean? The bulls have tried to break above a certain price level 3 times. They failed. Bears come in with an outside candle. It's a trading range, so we don't want to take the first trade, first entry, because it's likely to fail. So attempt to break, fails, big candle, nothing for you to do. There's nothing for us to trade there. So now we have this low here. As I put the wedge in there for you to see. But at this point, you'll have that low there, and you say, okay, we're creating a trading range. We failed to break beneath it here. Now we have a double top. Double top, if you get a double top, you wait to see get a lower high. We don't get a lower high. We have an attempt by the bulls to break out about that, and then a decent reversal, which is fantastic. So now we have a high 2-bar reversal, and all we wait for, guys, this is important. You've seen that. Beautiful. Don't jump into it, okay? Because it's still above the moving average. Okay, it's decent enough, but if the bears are strong, they will give us a close beneath the average. We just want a close beneath the moving average to confirm that the bears are strong. So there's a close beneath the average, beneath the moving average. It's tails on top, bit of a dodgy, not nice to take, reduces the probability. But this inside candle, you got to take this inside candle. Okay, put your order beneath that, stop above that, because it's above our lower high, double tops, etc. But that you've got to take, and your first price is to get to the low of the trading range, and if you can manage it, because coming just beneath here is a magnet. The low of yesterday, the market is likely to get that. It may break through it, or it may bounce. So if you're able to just hold and see what happens, okay? So you might be able to take your profits out. But if you're going to hold on to trades, you have to take your profits out, okay, at the level. Okay, so you get there, take the profits out. If you aren't fast enough to take it, don't close when the candle is open, okay? It may look frightening, but just let it be and see what happens. So, we then get the lower highs forming. And then, okay, sideways price action, trading range. Remember what we said, lower high, want to see what happens in the trading range and see if we get that's a double top, double bottom. Then want to see whether they get higher, lower high, or we get trend continuation. I just want to look at S&P 500. I think I got carried away in the euro. So I read that portion equals share, but the same kind of thinking applies. So S&P 500, I like to trade the S&P 500, especially if I'm tied up with other things, because it's my whole day can go, my daylight day, and then I can jump into the market in the afternoon and just trade it into the evening. So, but what it does, it gives you options, because the volumes are 24/7, but in the afternoon when the US market opens, you just get a lot more volumes coming in. Low of yesterday, high of yesterday, 50% pullback, open of the day. let's just have a look at what's happening on the day. I mean, again, this is one that we've spent a lot of time talking about, and everything is forming quite nicely. What I want to point out, which is interesting, whatever time frame that you're trading, is that we are in breakout mode. Remember, we got excited with the break of this this massive trend line from last year. Okay, remember, this is from February, sorry. So it's already there because of that, but you could take this all the way back to April. Okay, with this trading range, and then the breakout started here, but there's a pullback, and then carried on. But for our purposes, we've just focused on that's very strong. You know, there's all sorts of things we can talk in there. But we started saying, hang on, if the bears are strong enough, I think we're in here when I say this is quite interesting. For the first time, if the bears are strong, instead of just bouncing off this trend line, they may end up breaking beneath it. And they did create a trading range. Bulls tried to reverse it, decent lower high for you to have traded, for you trading that on the daily. But what's important is what's formed here so far in the month. We have an inside candle. An inside pattern is a breakout mode pattern. In terms of that particular pattern, at the present moment, it favors the bulls because the bulls are the latest inside candle. But its overall thing is a breakout candle, breakout pattern. Inside is a breakout pattern. What it means, however, is if the market breaks out beneath this candle, okay, most breakouts fail. So there might be a failed breakout and then an attempt to test that trend line, then you can look to go short. Or if the bulls come into the market and they break out above that, you look for the pullback to trend. Whatever it is, whichever way they go, the magnet is a measured move of that channel, of that breakout mode, so the high and the low. And again, if the bears are successful. Now, would that surprise you? If the bears are successful, would that surprise you getting there? It wouldn't. Why? Because out of this trading range, that double bottom, there was a measured move that we said the market may get there. Out of another one created, yet there is a measured move. Here's another one created. Nothing is accidental. Okay. So how does it affect us intraday? All it does say to us is, once again, these levels of support and resistance are extremely significant. Low and high of yesterday. You got to track that and have a look at it. So pretty interesting stuff, but we are running out of time. So if anything develops, we'll have a look at it in future. But my request to you guys is just take some time, clean out your charts. Doesn't matter how you trade in, full respect to any strategy that you have, but clean out your charts and only have your 10 and 20 EMA. The 10 EMA is a thick blue line here, and the 20 EMA, and just look at it and ask yourself what is happening. Once you start to grasp how price is moving in front of you, you can then take that and apply it to whatever other strategy or indicators that you use. Just gives you that extra wealth of information. So what am I looking for at the present moment with S&P 500? Again, we have a trend line here, and if we're breaking above that, which we've done, I want to see a strong breakout. Is a trading range forming? If it is, we are in that major trend reversal alert that we have. Trading range where I look for a double bottom, double top, where I look for a lower high or a higher low, where there's trend continuation or a reversal. So that's kind of my thinking process at the moment. But I think the beauty of it is, if you trade in the 5 minutes, if you stick to a few strategies, everything slows down dramatically. So there's nothing frightful about it. If you come in and you have a million ways to trade and a million charts to look at, it's just going to be a nightmare. And you're going to mess up your trader's equation, risk, reward, probability. We can manage our risk by what percent we put into the market and where we put our stop loss, technical positions. Reward, we decide, let's take our profits or let's manage, we can do that. Probability, the market throws at you. That's why you need to have distinct strategies to manage your probability. So, you know, our pullbacks in the trend, 60% works 100% of the time. But it can be more. If it's set up neatly, it can be 75, 80, but I don't put that in my head because then I can start to get arrogant, right? Major trend reversals. I know if I set up and I can get into that position early out of a trading range and still be able to take in my pullbacks, man, I'm getting to 3-to-1, 4-to-1, getting quite significant returns. But then you just wait until it sets up. Guys, thank you very much. Thank you for everyone who stand up, my old participants, my old friends, the new guys. Sincerely appreciate it. We'll catch up again next week. I'm on Trading Buddies, Jeff and Ash's show, just for 15 minutes just 15 minutes after the session opens London time. Next week on Tuesday. We'll see you guys. Thank you very much. Guys in the office, thank you.